So the U.S. stock market right now, Hardika, I'm curious with the way that not just to seeing the trade today, but in general, where for much of April, or rather March, investors were very concerned about what was happening in Iran and the Strait of Hormuz. Now they seem not to care at all. We were told it would be earnings, is really why. Why do you think they're looking past the geopolitics?
Yeah, of course. And thanks so much for having me. It really seems like such a surprising reversal, right? Earlier, we saw oil prices rallying and then stocks going down. But now it seems like stocks don't really care all that much about it. I mean, just today, oil is at above 100 a barrel, right? I think some of that has to do with investors sort of just getting really worried ahead of this war just getting dragged out. And I think those expectations were just brought forward to the present. And I think that's why stocks are doing so well right now.
What about, I mean, you go to things like the earning fundamentals. We did a story last week that just said, listen, earnings were coming in so good. At some point, people have to say, why wouldn't I buy stocks? You know, it supports the valuations. There's some of that going on as well, correct?
Yeah, I mean, the expectations were pretty high to begin with, given that there's a war going on. And somehow those expectations have just been blown out of the water. I mean, companies are expected to report the highest earnings growth since the fourth quarter of 2021. This is a crazy stat. And it's not just the earnings growth rate itself, it's also the magnitude of the beats. Beats are expected to be the strongest since the first quarter of 21. When I think about it, I think that earnings, which are expected to be the true driver of stocks, it's good to see stocks going up because of earnings, because I think it's all being driven right now by tech stocks, right? And they're doing super good. We have, SanDisk did really well in its earnings last week. We haven't even received Micron's earnings yet. So I think that there's a chance for this to go even more explosive.
But it's not so broad, and I think that's the concern that some people have. Still, there's the concern around AI disruption and software. Some of those companies have been left behind. Other companies have been left behind as well. That their sectors have been left behind as well. What does it mean to you that this is relatively concentrated?
It's a vertical climb in shares of memory stocks. And that to me is just eye-popping. I mean, Intel was left for dead last year, and this year it's one of the star performers. How crazy is that? And when you look at the gains that these stocks have just posted in the past 6 weeks alone, when the stock market started recovering, I think it makes you feel like this just can't keep going on, right? Like that's a big concern. And like you said, when you look at what's happening across the broad market, it doesn't seem like the rest of the stock market is participating to the same extent. You look at 50-day moving averages, you look at 200-day moving averages. So I think that's a very valid concern. But I think at the end of the day, I think this rally in memory stocks is sustainable, as crazy as that sounds. And I think that's because there's still such a shortage for memory right now. And I think as long as demand keeps outpacing supply, which is expected to be throughout the year, I just don't see this rally slowing down. I thought it was over earlier in the year when Google released this research paper saying, hey, in the future, we might not have such a great need for memory. And that led to a small pullback, but they came back roaring. And I think it just shocked everybody. Everybody thought that these gains are over, but they keep going on.
Well, one thing I want to ask you, I mean, Michael Burry, a story definitely caught. It's among the most read on the Bloomberg. Our Jess Smetten putting it out. Michael Burry, of course, the investor made famous in The Big Short, leading up to the great financial crisis, that mortgage meltdown, warning that the NASDAQ 100 index is headed toward a dramatic reversal after a parabolic surge that has driven tech valuations to unsustainable heights. He put out a post on Substack, and Burry's saying that the market resembles the peak of the dot-com bubble just before its burst, citing in particular the steep jump in chip stocks that has pushed up the Philadelphia Stock Exchange semiconductor index by nearly 70% since the end of March. And I'm just looking, there's another one, Jason Goepfert over at Sundial Capital Research talks about, and I guess also some research from Bespoke Investment Group, that when the SOX has pushed this far above its 200-day moving average only two other times, they note, in July of 1995 and in March of 2000 at the peak of the internet bubble.
What happened after that?
Exactly. I'm just saying, like, we every day are often citing the semiconductors and the continued rise up. Today, we had, I think, record hits on both Qualcomm, Micron, and I think Intel out of the gate today.
Yes.
When is it really justified? How do we know, especially with all the circular financing that's going on in the AI build out?
Yeah, that's definitely a valid concern. It's, as an investor, you should be worried about, if valuations look too stretched. I think that the way I look at it, valuations are one tool to measure how stocks are, if stocks are running up too much, too far, too fast. For me, I think that as long as earnings are still growing, there's no reason to sort of think that the dot-com bubble peak for valuations was it, and stocks will never cross that boundary again. That's just not feasible. Just because that was the high doesn't mean that stocks can go punch above that because earnings are growing at the same time, right? To me, that just seems like an opaque boundary for no reason. In my opinion, the S&P 500 on pace for its 16th high of the year today, to me, just signifies that, investors have processed this war and processed the fallout on energy prices from this war. They don't care about it. They're looking forward ahead to the potential of AI. And I think that given this rally we've seen in memory, I think the AI bull cycle is still very much on. It's still very much taking place. And regarding Burry's comments, I think he just has a very bearish outlook. He has called 15 of the past 16 bull markets, or something like the saying goes.
I just get nervous when everybody is so enthusiastic. Truth be told,
and it's gone up so fast, right? Again, like the vertical climb. I've just never seen anything like this before. It's explosive. So yeah, that's valid, but I just don't think that valuations alone should help you make that decision on thinking that these stocks can keep going on.
Well, I think would you consider raising your target? It's at 7,700 right now for the end of the year. Would you consider raising that now? Because we're already at 7,424.
Yeah, I saw Yardeni raised his, so I definitely feel like maybe I should raise it, but I'd have to take another look. We have to see how stocks finish out this earnings season. And then with the Fed later this summer, I think those are some of the key things to watch. If stocks can push past, all the headwinds that are going to happen with the Fed, I think it might be worth raising that to above 8,000. Yeah, for sure. Because Kevin Warsh, we don't know what kind of Fed chair he's going to be. And interest rate cuts, they're potentially not coming this year because of how high gas prices are. I mean, tomorrow's CPI.
Is that the risk? Is that the risk? Just got 20 seconds. If we don't get rate cuts, is that the risk to equity valuations in your view?
I think it might be in the short term for sure. But I think at the end of the day, it just means the rate cutting cycle is getting prolonged, which could still be bullish for stocks because we're going to get rate cuts next year. But in the near term, yes, in the summer, 100%.